This episode is brought to you by Quarter. Quarter is the new way of doing company research. Quarter's first mission is to enable access to conference calls, investor presentations, transcripts, and earnings reports as frictionless as possible, straight to your pocket. I started using Quarter and I've never looked back. You can think of Quarter as the Spotify for all investor conference calls that you can think of. You can type in the ticker of whatever company you want, say it's Etsy, and you can get a list of all of their recent earnings calls, and inside the earnings calls, you can listen and click the PDF and it'll show you investor presentations or prepared remarks that you can read alongside listening. The best part is you can choose the speeds. You can have 1x, 1.2, 1.5, which is my favorite, and you can star companies, make them your favorites, and you'll get notifications for new conference calls, and they'll be right at the top of your app. So there's 5 key points to remember about Quarter. First, it's 100% free. They include companies from 12 markets and plan to add more over the coming year. They prioritize requested companies, which you can do in the app, and they have a lot more in store. So check them out on wherever app store you have. It's QUARTR. That's QUARTR. Before we dive into today's conversation, I want to talk to you about MIT Investment Management Company, also known as MITIMCO, the investment office of MIT. Each year, MITIMCO invests with a handful of new emerging managers who it believes can earn exceptional long-term returns in support of MIT's mission. In order to help the emerging manager community more broadly, they created emergingmanagers.org, a website for emerging manager stock pickers. For those looking to start a stock picking fund or those just looking to learn about how others have done it, I highly recommend this site. You'll find essays and interviews by successful emerging managers, service providers used by MIT's own fund managers, essays MITIMCO has written for emerging stock pickers, and more. MITIMCO also occasionally and opportunistically hires new members for their investment team. To view the job description, please visit mitimco.org/global-investor. That's mitimco.org/global-investor. The MITIMCO team spends their time learning about great businesses and investments, working with exceptional investors around the world in order to support generations of MIT innovators. I'm also excited to announce our newest sponsor, Tegus. Tegus has the world's largest collection of instantly available interviews on all the public and private companies you care about. All you have to do is log in and type in a stock ticker or a keyword. For example, if you're interested in gaming stocks, you can type in RBLX for Roblox, or type in the keyword metaverse and instantly read hundreds of calls on the company and industry. Tegus actually makes primary research fun and effortless too. Instead of weeks and months, you can learn a new industry or company in hours, and all from those that know it best. Now, I only sponsor products that I use every day, and Tegus is no exception. Since joining, I spend nearly all my time reading Tegus calls on existing companies and new ideas into my portfolio, and I know you will too. So if you're interested, head on over to tegus.co/valuehive for a free trial to see for yourself. Again, that's tegus.co/valuehive. Hey guys, this is Brandon, the Matt Garops Value Hive podcast. This week's guest is Steve Forlick. He is a portfolio manager at Firebird Asset Management. I first met Steve in 2019 at ValueX Vail. We talked about different ideas. I forget the name you pitched in 2019, but I remember the name you pitched this year. But I think what cemented my kind of thoughts about Steve is like, man, this guy's like a legit hiker, because we hiked that big that kind of one big mountain in Vail where you literally start at the bottom, go all the way up to the top, and then take the gondola down. And I'm sitting there, it's like myself and I think Scott Miller's in the back, and we're just like huffing and puffing, and you and Stephen Wood are up there just like not even breaking a sweat, and just talking about as a machine. Yeah. Gosh. So where did you get your start in investing, for those that don't know? Because one thing that I wanted to have you on the podcast for was you're criminally underfollowed on Twitter. And I hope that this podcast changes that. So for those that don't know, how did you get started in investing? And then where did you end up, or how did you end up at Firebird?
Yeah, thanks. And Brandon, first of all, thank you so much for taking the time to speak. My history with investing goes back to mid-2000s, and I was always interested in investing and being in investment management. But after undergraduate, I was a consultant for a few years, and then went to business school with the idea that I do want to switch to investment management. and didn't really have a particular idea of what I want to do aside from knowing that I like fundamental research. And in the middle of my first year in business school, I came across an article in Wall Street Journal that talked about investing in Russia, and had a quote from one of the founders of this fund, Firebird Management, that happened to be in New York. And I realized that that has to be it. That is the place where I want to work. After learning a little bit more about it, that the conviction only grew stronger. I kept calling them until they picked up the phone, and after a little while, convinced them that to give me a chance, and started out as a summer intern there back in 2005, and I'm still there. So it's kind of this circumstances, a little bit of chance, but very happy to be working there. And the fund is best known for investing in Eastern Europe and Eastern European equities. It's a fascinating part of the world, and I absolutely love my job.
There was clearly something that pulled you when you first read about Firebird, and it sounds like it was the whole idea of investing in Eastern Europe and Russia. Why was that such a strong draw? I mean, I know, you've got an accent, you've got almost like an Eastern European accent there. So clearly there's some sort of heritage involved in maybe that kind of longing to kind of know a little bit more about those places. But what led you, like, what was it about Eastern Europe that kind of really gripped you?
Well, I mean, it's as simple as that fact that I'm from there. I'm originally from Belarus. We moved to the United States as refugees when I was 12, and but kind of always stayed in touch with the Eastern European roots and background. Both my wife and I speak Russian at home. We taught our kids Russian, so it's always been a big part of my life. And when I realized that I can combine my this background and my interest in investing, that was it.
What's the best way to learn Russian? Because I took Russian as a freshman in college for one semester, and I loved the language. Like, I fell in love with the language, but it was brutally difficult to learn. Like, I did Spanish for 4 years. I can speak Spanish fairly decently, but Russia's like, the learning curve for Russian is unbelievably steep.
I'm probably not the best person to ask that because I grew up speaking Russian, but I think immersion is it. One of Firebird's founders, Ian Haig, he's not a native Russian speaker. Actually, none of the 4 founders had anything to do with Russia. But Ian did study Russian in college, and then worked as a translator on a Russian fishing boat in the Pacific for a little bit. It's a fascinating language. There's a lot of angles to it. But I think just like with any language, you have to immerse yourself in the language and in the culture, and that eventually it seeps through.
And kind of pulling at culture, because there's a theme of kind of taking a top-down approach, which we'll discuss later. But in terms of culture in these Eastern European countries, what are some things that U.S. investors just might not know about the culture? And for instance, like in Japan, there's a specific business culture, and like there's things that they do in Japan from a corporate level that are a bit different than what the U.S. does. Like, what are some of those kind of parallels in Eastern Europe that, someone like myself who just has, a monitor and a laptop and a screener for Eastern Russian stocks wouldn't know?
I'm not sure how much of it is Russia specific, but I think it would probably apply to all emerging markets. And I think there is a lot of local knowledge that goes into doing well in a market that you don't know. And it specifically touches on people where you have this tendency to be a contrarian and, oh, look, something is cheap, I want to buy it because it's going to go up more. Mm-hmm. It's a dangerous thing to do in any market. And including Eastern Europe, I'm sure it's the same for Asia, I'm sure it's the same for Latin America, you kind of have to understand why something is cheap. And you also have to understand the people that you're trading against, more likely than not, know these companies much better than you do.
Right.
And you have to get comfortable with it. And that is part of the reason why we never became general emerging market investors, because we know Eastern Europe, we know those markets. Some countries we know better, some countries we know worse, but we also know that. We know where we're Patsy at the table. And that's why we never felt comfortable going to Latin America and investing there. I never felt comfortable going to Asia and investing there because we just wouldn't know what we know in Eastern Europe.
And do you think it's even worth, and this is an introspection question for myself, do you even think it's worth someone that doesn't have that local knowledge or someone that can't do the traveling? Because I know you travel a lot to these countries. Is it even worth it to look at these places and try to make bets on company fundamentals if you don't have that local knowledge?
I think so, but one thing that I would warn about is trying to find the cheapest stock.
Okay.
That I don't think that works very well. But if you, as an investor from a developed market, can find a high quality stock that may not be the cheapest one, right, but you can kind of, based on your experience in other markets, can tell how this industry can develop, how the opportunity zone for the company could develop, think you can make really good money. This has been one of the themes that we have been exploring in the last few years is the companies from Eastern Europe that are truly world-class companies, but are being misunderstood or cheaper than an equivalent in another market. But it may not be, if you have two companies within the same industry and one is better and the other one is cheaper, I would caution against the one buying the cheaper one just because it's cheaper. Mm-hmm. You may find out later on through your research that it's better and cheaper, and that then this is the holy grail.
Right.
But buying something just because it's cheap has not been working out very well in our markets for sure.
Yeah, that's an important distinction because early on in my investing career, I would look at emerging markets and try to figure out like a risk premium and then pay a cheapness discount, right? Where you're looking at, I only want to invest in, Russian stocks that are trading at a 5 PE or less, because in my head, I was associating the risk of that emerging market with the relative PE or equivalent, when in reality, and you said this well, is you should match the risk of that emerging market and kind of your lack of knowledge with the highest quality business, and then valuation comes into play after that. So it's like focus on the best businesses to make up for what you don't know on the local level.
Right, and this is you getting to the point of quality of earnings versus just the multiple. And one example that we give is that if you look back at a Russian market back in 2005 or 2004, the PE of the market was 7, so it was cheap. Mm-hmm. But the dividend yield was 1 or 1.5.
Yeah.
So that earnings were there, but what happened to those earnings was kind of unclear. How were these earnings reinvested? It was unclear. Today, when we look at a Russian market with a PE of 9, relative to global markets trading at 20, but our dividend yield is around 6.
Wow.
So the quality of earnings in our markets has improved dramatically. And I think that's one of the things that kind of most investors that don't look on this on a daily basis haven't realized. Mm-hmm. But the quality of the earnings have improved dramatically. The decision-making at the companies has improved dramatically. And that's something that should translate into superior returns for investors, or at least we hope so.
And when you use that 9x dividend, or that 9x PE paired with the 6% dividend yield, do you also look at other metrics to kind of gauge quality of earnings? So for example, like buybacks, is that, how prevalent is that in the Russian markets for companies to do? And then are there other metrics you look at for quality just besides the dividend yield?
What we look for is how the companies reinvest. Okay. So from the quality of earnings point of view, what we look at is the opportunity zone, and what kind of returns can the companies get on reinvesting capital. Because we're dealing with a lot of the economies that are growing relatively fast, mm-hmm. and especially if we go outside of Russia, which is more dependent on oil, but if we go to places like in Eastern Europe, like the Baltic countries or Romania, these are the countries that are growing at 4 or 5% per year in real terms. And the opportunity to reinvest for high quality business within a country like that is pretty good. So if you can find a business like that is reinvesting smartly, then this is one of the things that we do look at. And the dividend yields, and what happens in a lot of cases is the dividend yield that we're seeing is the residual of the cash that was reinvested into the business. And if you have a business that's returning you a 20% ROE and growing 10% per year, well, you can return half, right? And because a lot of the companies that we're dealing with have a very high proportion of insider ownership, you do have the owner mentality in terms of how these businesses are run. Yeah,
there's so much that we can pull from, and I'm actually getting super excited about this conversation because I have loved Russian stocks and emerging Europe stocks since I first kind of found the stock market, really, which is weird, right? But it's just kind of, that's how it happened. I do want to push back a little and kind of get your feedback on this idea of, Russian and emerging Europe stocks as being cheap, because one pitfall that investors, especially Eastern European familiar investors can say is, well, like, of course, Russia's trading at 9 times PE. Of course, Romania and Kazakhstan are trading at 7-8 times PE compared to the US or the UK. And, like, they're cheap for a reason. They're cheap because of XYZ. And there's always these kind of, I guess you could say, like, crux of the argument. Like, one of them, which we can dive into, is kind of rule of law, right? So you've got rule of law there. Then you've got, the ownership and kind of the alignment of shareholders. And then the third one is just like these lower quality, you alluded to it, or like oil-based, commodity-based businesses. Mm-hmm. And so, like, you take those three crux, and a lot of people say they should trade at that in perpetuity. So why don't we just kind of break each of those down and maybe offer a rebuttal, starting with rule of law, because I think that's probably the most important aspect of this.
Sure. So one of the things that's probably not very well known about Russia and Kazakhstan is that the letter of the law protecting minority investors is one of the best in the world in terms of the protections that you have as a minority investor based on the laws that are on the books. They're there. And they can be used, and you can go to Russian courts and defend your rights. And if somebody's trying to buy out all of a significant chunk of the company to get control of the cash flows, then they need to do a minority buyout. So the letter of the law is there. Mm-hmm. As far when we go to outside of Russia and Kazakhstan, and we go to the Baltic countries or Romania, those countries are within EU.
Right.
And the system of laws and the rule of law that you have there is very similar to what you would have in France or in Germany or in UK. Well, UK is not in the EU anymore, but that's the point, is that the perception of the rule of law and reality is somewhat different. And I think the perception, especially in places like Russia, is based on some of these exceptions to the rule that are loud ones that you will hear about asset expropriation here and there.
Like, can you give us an example?
So I think the most famous case is this company Yukos back in 2000s that was nationalized after the Mikhail Khodorkovsky, who was the majority shareholder of that company, he went against the recommendation from President Putin for oligarchs not to get involved in politics. So when Putin came into power in 2000, there was this big roundtable where he sat down with most of the Russian oligarchs and said that you guys can continue doing what you're doing, you own their assets, but never get involved in politics.
Right.
Most people listened, some didn't. I guess the most famous case from there is this company Yukos, which eventually was nationalized as a way of putting pressure on Khodorkovsky, who was also spent a lot of time in jail and is currently outside of Russia. But in no way am I defending one party or the other.
Correct.
In this case, but in stations like that are like where geopolitics are involved, you kind of have to realize certain risks there. And you also, I mean, the way that we look at situations like that, we want to understand how difficult is it to run this business? How difficult is to make money from the business? And when you have a oil firm where you can extract oil at $3 per barrel of $4 and sell at 80, well, anybody can do it.
Right.
So a business like that is probably more likely to be at risk to predation than a company like Yandex.
That makes perfect sense.
Which is depends on human capital, that operates in a competitive market where it competes against not just against other Russian companies, but against the global tech champions.
Yep.
And if this company gets taken away from the current owners or nationalized or something like that, well, it's going to become useless.
That's
so
very
we want
important.
to understand how well the business is run, how difficult is it to run it. Another thing to understand is kind of whether there's been an original sin in the creation of an asset. So if an asset has not been created in the best way possible to start with, then somebody can go after the current owners based on something that happened in the past. And that's where this local knowledge that we discussed, that's where it comes in. And that's where we feel that we've been in the market for over 25 years. So we don't know everything, but we know a few things.
Yeah.
And that's what makes it a little easier.
And that makes perfect sense to me. Because using that oil analogy, it almost becomes a no-brainer for someone like Putin to say, look, like if you guys don't follow me, like a monkey can run this business, right? If I know oil is at, like you said, if I know oil is at 80 and I can produce it and it costs me $4 or $5 to drill it out of the ground and produce it, like, yeah, I can roll it in. I can have one of my boys just run that and kind of oversee that. And then you can have, like manual labor workers take care of all the grunt work. But what's incredibly insightful is just that complexity aspect where someone like Putin or, anybody in his presidency, like there's no incentive for them to go after someone like Yandex because of the human capital. Like it's like there's the leap they need to make to kind of, bolt that into their operations is such a high cost. And then there's also an element, and I want to get your thoughts here, is a company like Yandex is almost like a beacon to the rest of the world that says like, look, like Russian businesses, like this is what we're capable of, right? Like this is the technology. These are this is the human capital. This is what we can do. And it's almost more powerful for someone like Putin to leave that independent and say like, this is what we are capable of.
Absolutely. It's Yandex is this other company, Tinkoff, which is one of the world's best fintechs. You're absolutely right about that. Is that I think the leadership in Russia understands that these companies are important. And moreover, let's say if you are President Putin, would you prefer people to do searches on Yandex, or would you prefer them to do searches on Google?
Yeah, be Yandex.
It would be Yandex. So, and you also know that if you nationalize Yandex, they'll start searching on Google.
Yeah.
Or at least a good chunk of the people will do that. Yeah. So that's something that I don't think is lost in the leadership. You do, as you said, these are world-class companies. These are high-quality businesses. They just happen to be in Russia.
So that leads perfectly kind of into that next crux, right? So we've got rule of law, and then we've got the ownership structure. And I think another hurdle for people to get over is if they see insider ownership or even kind of any ownership, they think like, okay, that those distributable earnings, like a portion of that is going to go to the Kremlin or to the KGB. Like that's just kind of like what people assume. It's like they're going to get their take. And whatever's left over for the shareholders is left over. But an important distinction in that, and this is something you referenced in a paper you sent me on China versus Russia, is the shares that the minority owners hold are the same shares that the majority owners hold. Same class. And so walk us through how that plays an important role when it comes to ownership and the sense of ownership and rights as a minority shareholder in Russia.
Right. So, and I actually don't know how much, in terms of your comments on what portion of the earnings goes to Kremlin or goes to corruption.
Yeah, I mean,
I
that's
think
just me like speculating. And
it's industry by industry, company by company.
Yep.
With most companies that have been around for 20 or 30 years, there are some rumors in the market about who actually owns these shares. Is the majority owner really the 70% owner? There are other people behind them.
Yeah.
And frankly, in some cases we hear rumors and others don't.
Mm-hmm.
But the important thing here is that, and this is something that we touched on already, is that in most companies where we invest in, the earnings that have not been reinvested back into the business are more often than not being paid out as dividends. And the share that I own is the same share that a majority owner has. And the 5 rubles per share that I get as dividend is the same 5 rubles per share that he or she gets.
Correct.
So from that point of view, going back to what I was saying earlier, there's 2 things that we look at. We look at how companies invest money, and we look at what happens with the residual cash. And if we're comfortable with both, that's great. And we'll buy into the company if it's a good company. And if we're not, we'll move on. In one example from our market that is kind of this poster boy for cheap, but God knows what happens there, is this company Surgutneftegas. I don't know if you ever heard of it or not. But
I probably have, but I only know it from like the ticker symbol, if that even makes sense.
Yeah, the ticker I think is SNGS.
Yep, exactly.
And it's probably one of the more famous cases in Russian market for anybody who looked at it, is because this is an oil company that is, today's market cap, I think, is $17 billion.
Okay.
And it has net cash of 21 billion.
So by the transitive property, it's a net.
That is a net. But the question is, what happens to the cash? It is possible.
Yeah.
This is also the same company that for a while, nobody really knew whether there was 40% of the shares in treasury, whether they actually existed or not. Because this is a company that didn't file a IFRS financials for a period of 10 years or so.
Wow.
So there's a company like that is undoubtedly cheap, that pays a little bit of a dividend. But what happens to the rest of that cash is a mystery wrapped in an enigma.
Yep.
So you can look at it and say, oh, look, there's $20 billion worth of cash, and I own a chunk of it. Or you can look at it and say, well, there's a dividend that I get, and I can look at that. Or you can look at it and say, this is too complicated. Mm-hmm. And I'd rather own a company like Lukoil, which is also an oil and gas company, that is, on a multiple basis, much more expensive. I don't know if it's expensive in absolute terms. I think Correct. It's trading right now at around 4 times EBITDA. But I know how the company is operated. I've spoken to the management a number of times and know exactly how they're thinking about from a point of view of reinvestment and opportunity zones. I know how they allocate capital, and I'm very comfortable with that. Mm. And I know what they do with the residual cash. And in that case, they do dividends and they do buybacks as well. Mm-hmm. So it's a range.
Yeah, and it's a range based on probabilities of certainties. Like, how certain are you that this cash exists versus how certain are you that this cash is legitimate? Like, there may be a 20% probability in that, in that net that the cash is real. And then 20% of 20 billion might not be as much as, say, like if you've got an 85% chance or an 85% certainty that there's, 15 billion in Lukoil or something.
Right. The cash is real, probably real. It's just a question of whether you'll ever see it as a shareholder.
Right. When you think of Russian equities and business opportunities, I'm kind of expanding out here over the next 5 to 10 years. And the only reason I'm kind of thinking about this is because you've got like a lot of oil-based businesses juxtaposed with a lot of this information age type companies like fintechs and all these things. Over the next 5 to 10 years, do you think that there'll be more opportunities in Russia to invest as the economy transitions at some point, or do you even see the economy transitioning to a point where like there will be more of these internet information age business opportunities available in Russia?
It's a very important point, and I think it kind of once again going to the multiple that at which the market is trading, and to your point of whether Russia deserves to be always trading at discount. I don't have the numbers in front of me, but if you look at 10 years ago, the structure of the index, it was much more geared towards resources and oil and gas than today. Because today, as part of the index, you do have companies like Yandex, you have companies like Tinkoff, you have a few consumer-oriented companies. There's this grocery chain X5. There is a number of companies that have been built over the last few years and listed either in Russia or in another market like London or US,
right,
that are now kind of allow you to invest into that market. And the structure of the index has changed. And what we're seeing, especially this year, is the number of these new companies coming to market seems to be accelerating dramatically. And I don't know to what extent this is just the nature of the nobody cared about this market for the last 10 years. But we went from 2 IPOs a year to literally 2 IPOs a week in the last 3 months.
Wow.
And it's these companies that everybody knew for the last 5 or 6 years that eventually they'll list.
Right.
But now they're listing. And we're looking at them, and some of them more interesting, some of them are less interesting. But the fact that these companies are now being added to our investment universe is a fantastic thing. And
that almost goes right into, the whole Munger quote, fish where the fishermen aren't, and kind of fish where the fish are. If you're in a market that went from 2 IPOs a year to 2 IPOs a week, I mean, that's almost the equivalent of like a farmer dumping a bunch of salmon into a pond, and the farmer goes from dumping 5 salmon a week and to 25, 30 a week, and the opportunities there just explode.
Right. And in this case, I think it's somewhat of a kind of interplay between supply and demand, because for the longest time there hasn't been a lot of demand for Russian equities. This is a market that's been an international pariah for decades, probably at this point. And I'm sure most people, including the people who are listening to this podcast, the first thing that they'll think about investing into Russia, the first question is going to be, have you read the book Red Notice? And then they're going to ask me how do I know that I actually own these stocks? Yep. And it goes on from there. Mm-hmm. So you've had, for the longest time, you would have done very well being an investor and not thinking about Russia at all, and not thinking about emerging markets, and just thinking about buying compounding stocks in the United States.
Yeah, just buy the Qs.
Yeah, exactly. And Russia did not have a significant domestic investor base that would take up the slack from the foreign investors. Mm-hmm. And that started to change about 3 or 4 years ago, when the Russian retail investors started putting money into the market. And the reason for why that happened makes a lot of sense, because historically, Russian people used to save via deposits.
And what are those?
Just like your deposits in the bank, because you were able to get 10% interest rate on your ruble deposit in a pretty good bank, because that's, the inflation was around 6-7%, maybe a little more, but you were getting a pretty nice return on your deposits, just by simply having the money in the bank.
Yep.
Those deposit rates have been coming down dramatically. The inflation in the country has come down dramatically. And now, if you want to have your money in Sberbank, which is the safest bank in Russia, and you want to have you have your money there, well, you're getting, I think, 3 to 4% on your deposits, which seems like a lot for Americans where you're getting zero. But it doesn't seem a lot when you used to get 10. And it also doesn't seem like a lot when you can buy Sberbank stock and get a 6% dividend.
Right.
So you have a segment of a population that is not huge, but is increasingly, it's growing. It's getting there. I think at this point, there is about 8 million open retail accounts in Russia out of a population of 120 million people. So we're nowhere near Robinhood levels.
Yeah.
But it's growing.
And do you get that data from like the MOEX or something, or how do you like find that?
Okay. Moscow Exchange is very good about providing this data. They provide the data on the number of retail deposits and number of retail accounts and how much of the trading comes from retail. Moscow Exchange, we can talk about it separately, but it's a world-class exchange. Also a listed company.
Yeah.
But this domestic investor base, and you can see that in how stocks are trading, especially not the top tier stocks like the Gazprom and Sberbank, that if anybody wanted to buy anything in Russia, they were probably buying that either through ETF or directly. Correct. But some of the second tier stocks, how they have been trading over the last 2 years, you can see the liquidity improve. You can see them becoming a little less volatile in a lot of cases. You've had situations where a big sell order from a foreign fund that's liquidating that would kill the stock for like 3 months.
Wow.
That happens much less often today.
So are those shareholders longer term focused or shorter term focused? And I know that that's probably a huge, like open-ended question that might not even have an answer. But the one thing I'm comparing it to is I spent a lot of time studying the Japanese markets and especially like the emerging mothers index over in Japan. And what I found was there was a lot of younger retail investors going into the markets, and they were very short-term trader oriented. They'd flip them, day trade these things, and there wasn't really a long-term ownership mindset. Do you kind of have a pulse or, a finger to the wind on the ownership mindset of Russian investors, retail investors?
I don't, but I'm guessing a retail investor in Russia is not much different than a retail investor anywhere else in the world. You have some investors that are looking at it from a long-term perspective. This is a savings mechanism. You have other investors that are short-term trader mindset. But the most important point here is that they exist in a place where they didn't before. And you have millions of people making individual investment decisions where before they didn't.
Mm-hmm. I mean, that's huge, just untapped demand for local stocks. And it seems like something that Putin would really get behind. I hate to pull in kind of the geopolitical, pontificating here, but just like, if you want to spur local investment, like what better way to do it than say like, hey, like, let's get everybody on our Russian stock exchange and like, let's everybody invest in our own Russian businesses. Like what kind of better way to back your own country?
I haven't seen a pronouncement like that from the president.
Mm-hmm.
But yeah, you're right. What we've seen over the last few years is a discouragement of offshore structures,
right?
Where the government doesn't want the money that is made in Russia to be staying in Russia for the majority owners and not going to Cyprus. So you had quite a bit of cash that has been staying in Russia and is being reinvested in other businesses. Mm-hmm. And that's from a Russian point of view is not a bad thing. But once again, one thing that I want to be clear about is that there's no currency controls. So we as foreign investors in Russia can very easily move money in and move money out, and there's no problems with it. And Russia is part of international financial markets.
Mm-hmm. Let's pivot to examples of world-class companies in Eastern European markets, because I think that getting an example of, one from kind of each we'll call it Romania, Georgia, Kazakhstan, Russia, from ones you haven't mentioned before, would paint a good picture for people listening. Like there are world-class businesses out there that aren't the FANGs, that have deeper competitive advantages, wider moats. Let's start in Russia with we can start with MOEX, which is the Moscow Stock Exchange, because I think that's one that's easily understandable from an investor from kind of an investor's point of view, and then B, again, probably one of the deepest, widest moat businesses out there, just in general.
Right. So this is, I thought you were going to start with Yandex, but I guess let's talk about MOEX.
No, we'll go to Yandex next.
So Moscow Exchange, MOEX, it is pretty much the main exchange for almost any kind of financial instrument in Russia. That includes bonds, that includes equities, that includes futures, that includes commodities, pretty much everything. Mm-hmm. And this is a company that has been growing its fee income by about 10 to 15% per year, together with the volumes. The fee income is coming from diverse sources, so it's not really linked to a particular line of business like equities. So you have all lines of business contributing, and some years, some contribute more, others contribute less. But overall, what you have is a company that's been growing fee income at about 10 to 15% per year, quite steadily. One interesting thing about it is that you may not be seeing it from the earnings that well, because the earnings come from two places. One is the fee income, and the second place is the interest that they're earning on customer balances. And this is a company that back in 2015, if I remember correctly, had about 50 to 60% of their income coming from interest on customer balances. And that was based on the domestic interest rates. And as I was saying earlier, the interest rates have been coming down. So that portion of the income has been coming down. So your overall income for the company does not look like it's growing between 2015 and 2020. It's actually, I think it's down a little bit. But the quality of earnings has changed dramatically, because where you went from 50% of the income coming from fees, at this point, you're closer to 80.
Wow.
And so you have this transformation in the quality of earnings in the company that for the longest time was just, I think, absolutely ignored, because this is a stock that didn't go anywhere for a few years. I think the market started noticing it a bit in the last year or so. But this is a company that is still trading at a PE of 14, a dividend yield, because this is a kind of, once again, the exchange business is not something that requires a lot of capital. So they can very comfortably pay out most of their earnings. So the dividend yield is over 5%. And if you look at an exchange anywhere else around the world, I think that multiples would be double. Right. So
at least in the developed markets, they would be doubled, like Europe and UK and US. For sure, they would be doubled.
Yeah. So
I mean, we can just look at CME, right?
Yep.
The CME group as an example. I'm just pulling them up on ticker, and they're trading at 31 times normalized earnings and almost 40 times free cash flow.
Right. And I'm not sure which one is going to be growing faster over the next 5 years. I don't know enough about CME, but I feel pretty comfortable with Moscow Exchange sustaining an earnings growth of 10 to 15% per year, the revenue growth.
Yeah. Well, the other thing too, and maybe, I don't know how much of this is like a net benefit to Russia, but it seems like there's way more competition in the brokerage space in the US than there is in Russia. And, I don't know if that's going to change, but you have, whether it's Robinhood or whether, like all the, common stock or, all of these platforms. I mean, you've seen it with banks now too, that are starting to open up their own brokerage arms and their own online brokerages where you can just buy stock in your bank account. I just wonder over the next 5 to 10 years how much that erodes from this like competitive moat that these like large brokerages have, where in Moscow, I don't know if there's going to be that same like drive to have all these decentralized brokerages. I mean, I could be wrong, but I'm just trying to think like in terms of moats.
In the case of Russia, you do have brokerages opening up, because we talked about the retail investors joining, and they're joining through companies like Tinkoff, through their bank, through VTB.
Okay.
So they are joining the market. But from a point of view of Moscow Exchange, it's a good thing, because you have eventually, once they join, they will be trading through Moscow, the equities on Moscow Stock Exchange. And one of the dynamics that we've seen happening over the last 5 years or so is that the equities that may have been listed both in Moscow and in London, for example, the trading volume is shifting to Russia.
Interesting.
Right. And there's a virtuous circle within that, because the more volume is in one place, the more likely the institutions will be trading there as well.
Yep.
Right. So from that point of view, Russia is taking share. So you have the additional listings, and you have volumes moving from London, which for Russian equities and for Moscow Exchange, that's a very good thing.
So is it fair to then compare the Moscow Stock Exchange almost as like a rails business, like Visa or MasterCard, that all of these newer brokerages are going to be built on top of?
Well, yeah, because at the moment, actually, it's a good question. I don't know if it's possible to do a dark pool where you can trade the stocks on the side without touching the exchange.
Yeah, because in that instance, like then the moat, I think, becomes more attractive. If they just become the rails that everything's built on, then then the switching costs just explode.
Right.
In 5 to 10 years.
That's the current status. And there's an interesting example right now in Russia where you have, so there's this exchange, St. Petersburg Exchange, that was launched a few years ago. And that's what Russian people are using to trade international stocks.
Okay.
And so if you want to buy Apple, your Russian brokerage will allow you to buy Apple through St. Petersburg Exchange. And this is a business that MOEX just kind of didn't really pay any attention to, but this is what retail investors wanted. You have over $1 billion a day of trading happening through that exchange. At least that's what was happening in the first half of the year.
Right.
And then MOEX saw that this is an opportunity that they're missing, and started adding that capability to their own exchange and listing these stocks on the Russian depository receipts, I guess, on MOEX, to allow people to be trading that in Russia, on Moscow Exchange. And they've taken a good chunk of that trading back for themselves. So this is another revenue line that has appeared literally out of nowhere within the last 3 years.
I'm looking at Tinkoff, since you mentioned, I'm just looking at their investor deck, and it is incredible. Their growth. And it actually, and just completely random here, one thing I really like about Russian equities is they do a good job of having English available transcripts and filings and websites, but B, they almost all of them have really good pitch decks. Like you can really, really understand the business, and they put time into their investor pitch decks, which is something I don't or haven't seen in other, like wide ranging, other like Eastern European or, just other broader Europe markets. Like they have very high quality pitch decks, which is nice.
So we had, I think, if we went to a day of meetings in Russia 15 years ago, you would have 5 meetings that are just downright weird.
What do you mean?
You don't know what they're talking about. It's not even like talking, it's not the same language. It's not even like on the same, we're not using the same terms. We talk in terms of revenue. They talk in terms of units produced, just like completely different things.
Yeah.
You would have 3 meetings that would be okay. And you would have 2 phenomenal meetings where like you're on the same page with the management. They know exactly what you're talking about. This is a world-class company.
Yeah.
Fast forward to today, you still have a couple of weird ones. Like they're still there. But you will have 3 that are okay and 5 that are world-class. And the other thing is that, so when I started 15 years ago, one of the competitive advantages that I had was being able to read the Russian accounting standards statement,
100%.
which was in Russian and 130 pages and unintelligible. And just learning what they look like and how to extract information from there, and where's the good stuff and where's the useless stuff. That was one of the things that I was good at in the beginning. That is absolutely useless today. Because all of these companies are reporting in IFRS, International Accounting Standards. More often than not, it's going to be, as you're pointing out, it's going to be in English. If not, it's in Russian, but you can use Google Translate. But it's a good thing.
Yeah.
It may not be great for me, as an analyst and competitive image, but it's a great thing for the market.
Yeah, and then it's like rising tide lifts all ships, right? So it's like, who cares if more people can understand this business? Like, that means more fund flows. And then at the end of the day, that's really what it, like, if more people see what you saw in Russian in English, that's a net benefit. Exactly.
And so going to Tinkoff that you mentioned, Oliver Hughes, the CEO, participated in Patrick O'Shaughnessy's Invest Like the Best podcast, I think a little over a year ago. Okay. And I strongly encourage anybody who's listening to this to go and find that podcast.
Yeah. So what's his name?
Oliver Hughes.
Okay.
He's a British guy who's running this company. And he did a much better job than I could ever do, explaining how high quality Russian companies think today, the opportunity set that's in front of them, and gives you a very good flavor of what kind of people are running these companies. And one of the most important things that he was talking about in this podcast is that from day one, Tinkoff didn't have the luxury of being able to invest to just growth for growth's sake. They had to think about profits from day one.
And is that because of lack of like private or venture capital in Russia?
Yeah, compared to the Western markets, absolutely. So after 2014, you had these two shocks to not just Russia, but in Eastern Europe, you had two capital shocks. First, 2008, where Western business, where you had before that, you had a lot of Western banks that were pumping money into Eastern Europe, especially in places like the Baltics, where 90+% of the banking system was owned by foreign banks. And they were earning much higher returns on their loans and on the book value in the Baltics than they had back home. So they were pumping money into the region. That was happening in the Baltics, in Russia, etc. After 2008, all of that money started flowing out as opposed to flowing in because of the problems that they had back home. So that access of capital became very problematic in Eastern Europe as a whole. In Russia, in addition to that, in 2014, you had this conflict between Russia and Ukraine. And there has been a number of sanctions that were put on Russian businesses and on Russian certain companies that are participating in the capital markets that made access to capital even more dire than it was before. So the companies that were operating within that environment had to learn how to make every dollar count. And that's where we saw, we've been there for 25 years. So we saw the quality of decision-making through that time improve. And I will never forget a meeting that I had with I think it was like 2015, with a company, a Russian state-owned company that was, I think their main business is like rolling stock for rails. And this is the type of company that in the past would be the weird meeting. And when I asked them, what is your ROIC on a wagon that you purchase? They told me exactly the time that it would take to pay back, how they're thinking about purchases of rolling stock. And this is a state-owned company. You have the state demanding that 50% of the earnings are being paid out as dividends today. to all of these state-owned companies. So that ruble, the dollar, pick your currency, the value of it has been ingrained in the businesses that are there. And that's why I think you get better decision making.
It's
or at least you had over the last decade.
It's forged by fire, where
exactly,
like in the US, and this is something that I've seen because I'm following the earlier stage, venture stage investing community a little bit more. Function of just I find it fascinating, and also I think it helps me become a better investor. But one of the things I've noticed is a lot of VCs are just kind of complaining about how easy the money is and how high the valuations are. And Bill Gurley talks about this. He did a blog post years ago about almost the perverse incentives and the perverse habits that come from an easy money, call it a regime, right? Where now with money so cheap, the entire game is flipped on its head, where it's who can burn the most money, who can burn the most to get the most market share because money's cheap. And there is an extremely attractive element of this forged by fire where money's expensive, capital's scarce, and you have to build a business at the start with core profitability in mind.
Right. And that's a very interesting point. And this is one of the things that we're kind of exploring as investors in the market, whether that is changing now that the companies do have access to capital, that the access to capital has become a little easier. And one example that we can touch on is the marketplaces business in Russia. And this company Ozon that listed in New York last year, I need to look up the market cap. I think it's over $10 billion. But this is a company that is almost $10 billion.
Yeah, almost.
And this is a company that is being encouraged by the market to grow as fast as they can.
Yeah.
So they don't have positive earnings, but every time they report a nice growth in a GMV, this is what the market responds to.
They're losing like $400 million a year right now.
Right. And so we have businesses that are competing. So we own companies like Yandex that are competing against them in the marketplace space. And the big question that we're trying to figure out, and don't have an answer to it, but the question that we are trying to figure out is that, is the company that is focused on profitability, is it a disadvantage to a company like this that is focusing on growth? And will this company just grow around it and eventually will figure it out? And so with a company like Yandex, we have the conversations with the management and trying to understand how they're thinking about it, because this is their life. This is their business. We're just there, along for the ride. And we're seeing them using the competitive advantage that they have. So Yandex's competitive advantage, let's step back for a second. Yandex, for those who don't know, is the Google of Russia and Uber of Russia, and is now trying to become, probably Amazon of Russia, because they're getting
incredible. It's
truly into the
incredible.
Marketplace business. And so, but what they're using, unlike Google in the United States, that never really participated in the marketplace and decided to make money on the advertising side, Yandex is seeing the opportunity to participate in the marketplace and building a Yandex market, which is your general marketplace. And they're doing it in a way that we think makes a lot of sense, where they have the top of the funnel advantage, where the customers are coming in and doing a search on Yandex. So by channeling those customers into the Yandex market, then you have to make sure that you have the stuff that people want to buy, and you can get that stuff to them quickly enough. And they've been spending money over the last 2 years on building those two things out. So they've been encouraging the merchants to list their products on Yandex Market. They have been investing both organically and inorganically in building out logistics chains. And also on top of that, they've added this Yandex Plus subscription service that is kind of like Amazon Prime. That gives you certain advantages by consolidating all of your online activity and purchases within Yandex. So what we're seeing them do makes a lot of sense. But on the other hand, they're competing against companies like Ozon that have seemingly unlimited access to capital, and they're using that to compete against them. And time will tell what's the right thing to do. But what the companies that we have, we want to make sure that they have a competitive advantage, that competitive advantage is still relevant. And if it is, we're comfortable backing it.
Let's really press into to Yandex before we go on to other countries, because I think, again, like I said, Yandex is like this beacon of the peak Russian business excellence, so to speak. For anyone that is remotely studied the company, it truly is incredible what they've built, and just the massive business that they are. So let's kind of take it segment by segment, because I think Google is a great example. Like, Google's got these different segments, all these revenue generators, and all these profit centers. Walk us through Yandex's profit centers and kind of take this one by one.
So the main line of business there and the profit center is still the search, the Google of Russia. So I think it's at the moment, it's about 2/3 of their revenues is coming from that, and the absolute majority of their profits. The next line is the Uber of Russia, Yandex Taxi. And it is actually the Uber of Russia, because at some point Uber merged their operations with Yandex when they realized that they can't compete against them. And they had a portion of the equity of that business in exchange for merging it, which they recently sold back to Yandex. But the interesting thing there is that this is a company that is making money. Unlike, I think Uber at this point is making money, but they've been much more profitable. Say it again.
I said, let me fact check that, because it's almost hard for me to wrap my brain around Uber making money. But
I think they're making money in the United States. I'm not sure if they're making money elsewhere.
Okay. Yeah, go ahead.
But Yandex has been making money in ride hailing much earlier than Uber did. And on top of that, they're building you have other this like logistics businesses that are being built on top of it that have to do with like Yandex, the equivalent to Uber Eats, the food delivery business. You have dark stores, like rapid grocery delivery business. So some of those are within that similar rapid delivery or like quick logistics segment that are using the infrastructure. And it's quite interesting. And they're definitely the leader in that in Russia. You have competition coming in here and there, but they're the leader in Russia. And the third business that is at this point is losing money, but we think is quite interesting, is the marketplace business that I was talking about, which is experiencing pretty good growth. They have the number of this Yandex Plus customers, the equivalent to Amazon Prime, that's growing quite nicely. So they have potential to, it looks like this could be another very strong business for them, but time will tell.
Okay. And one question I had is, what allows Yandex to have a profitable ride-hailing business so quickly compared to something like Uber? Is it just kind of domestic, local dominance, and it's kind of easier for them to scale that market versus Uber's kind of massive land grab attack? Like, what do you think is the differentiator there?
No, that's exactly that. Is that so? Yandex Taxi started making money once they stopped competing with Uber.
Got it.
And that's where Uber in the more established market like United States, where you kind of have this 80-20 split between the Uber and Lyft, they're making money in most places here. But in another place where they still try, so in Uber Eats, which is still a land grab, they're not making money. And in other countries where they're still kind of competing for market share, it's just more difficult.
I know we mentioned earlier just how low probability it would be for Yandex to get privatized by the government, but what do you see as the company grows and kind of just becomes this monstrous corporation? What are your thoughts on like a forced spinoff of different segments of their business where, it's almost the whole it becomes so large where you got to start, where the Russian government's like, look, you got to spin off the ride hailing business. You got to spin off this infrastructure.
They've been talking about spinning off Yandex Taxi. I know that's one of the things that's on their minds.
Mm-hmm.
Not because they have to, but more from a point of view of just realizing the value that's in there. That on a sum of the parts basis, if you're comparing Yandex to the equivalents elsewhere, it's cheap. Mm-hmm. I don't know if you should be valuing Yandex search the same way as Google search. That's a separate conversation. Or Uber the same way as Yandex Taxi. But it's still, even if you put a discount on it, it's still cheap.
Yeah.
So that will help you wait to kind of realize value there. Just an example on that. I think it was last week that this news came out that one of the companies that Yandex has developed under its umbrella recently raised money in US at a $2 billion valuation.
What company is this?
This is a company called, it was something that we thought we knew the company well, and
it's almost it sounds like it's almost the same as Google's like other bets category.
Yeah. So this company ClickHouse that we didn't know about.
Yeah.
That was developed within Yandex, raised $150 million at $2 billion valuation in US. And just from a point of view of kind of magnitude of what that means, Yandex is a $30 billion market cap company today. Like it's not Google with trillions.
Yeah.
So all of a sudden, asset that has a valuation that they own some chunk of, that has a $2 billion value, well, that's meaningful.
Yeah. I'm actually sending you, I just typed in ClickHouse Russia, and I'm going to put this in the show notes. Looks like Index Ventures might have invested in them. But it kind of gives a cool background, it looks like, of the history of ClickHouse and how it was founded, which almost brings me to another question before we go to Romania and then Kazakhstan. Like, what is, again, and forgive me if this is too loaded of a question, but what is kind of the founder ecosystem in Russia, and how has that evolved over time? My guess is, as more technology businesses make up a larger portion of the index, you probably have a greater percentage of these founder-led businesses, and maybe these like tech-minded founders comprising more of the Russian, call it oligarchs.
So one of the biggest mistakes that we had as a firm is not paying enough attention to the development of this tech ecosystem in Russia. There's other funds that have done much better job at it, but because we're value investors and kind of used to invest in things with assets that you can touch, we just at first missed it. And so probably not the best person to ask that question, because we're learning about it at the same time as you're learning. Okay. We know about companies like Yandex. We're trying to learn about other businesses that are there. We think that we understand them a bit better because we also do investing in the United States, where that's a big part of the market. So it kind of gives us that comparison basis and seeing, I can see what this company is. I can see what this company is trying to do. But I think just like in any other market, the fact that you have a few successes breeds other successes. And one of the things about Russian market that's always been the case is the high quality of tech talent. It's been a source of tech talent, both for domestic businesses and for international businesses.
Yep.
You have companies like Luxoft and EPAM that have built multi-billion-dollar businesses on taking Russian programmers and giving them to places like Deutsche Bank and making them work there. Right? So it's been, everybody knows that the Russian tech talent is there. It's just a question of what happens with it. And now increasingly, you see more and more companies being built by them that are these tech companies that, world class, once again.
It's like there's an ecosystem developing where it's at one point, if you stretch it out long enough, it's going to hit critical mass where it'll create this virtuous cycle where now Russian talent wants to stay in Russia, which will then increase the just amount of talent, which will then increase the amount of new businesses being sprung up domestically instead of internationally.
Yeah, and there's a lot of that goes into it. It's not just the money that you can make. It's also how good is your life here in a particular country. I'm not there. But I think this is the question, the things that people struggle with. And what I can tell you is that I've been traveling to Moscow for the last 15 years, except for the last 2, unfortunately. But over that time, the quality of life in Moscow, at least for me as an outside observer, has improved dramatically.
Interesting.
Just like by walking around or by going to restaurants, or the quality of stores that you can get your food from is just better.
Huh.
Geopolitics aside, I mean,
right.
Some people are happy, some people are less happy. I don't know, but like your day-to-day life in Moscow is better than it was 15 years ago. So I think a high-quality programmer who is comfortable with everything else would find their life easier there than they would in another place. If we switch gears and talk about different markets, like Estonia, for example, which has been a source of a number of multi-billion-dollar companies, like TransferWise and Skype and Bolt, another high-quality tech country of 1.5 million people, maybe. But if you are a programmer working in Estonia and making half of what you could in UK, your life is better because your cost of living is so much less.
Oh, yeah.
And you see people, and you see this net migration. You had the net migration out of these countries actually starting to reverse. Mm-hmm. And people are coming back because you do have pretty good quality of life.
Yeah.
And your dollar goes a lot further.
Yeah. And let's use that to kind of switch to Romania as another Eastern European market. And if you've got any world-class, like maybe just one world-class company out of Romania that you've either invested in before or just kind of have done a case study on that is a fantastic business.
Sure. So there is before I talk about Romania specifically, I want to spend a second on these countries that are converging, Eastern European EU countries, mm-hmm. and the idea of the convergence.
Okay.
And what's been happening there is that these are the countries that joined the European Union, let's say about 15 years ago at this point. Mm-hmm. And when they joined, there was a big difference in like average wage and the GDP per capita. It was like 7 or 8 times between, if you compare Estonia or Romania to Germany. And all of a sudden, these countries got access to a much broader market. And the people there got access to a much broader market. So you have this convergence that is happening as a result of that. And you have a natural growth rate that comes with it. And when we're looking at these countries and opportunities to invest in these countries, we're looking at the businesses that would benefit from it. And more often than not, those are either consumer-oriented businesses or banks. And if we're going to talk about Romania, one of the companies that has been a big success story for us over time, and it's still an important part of our portfolio, is this bank in Romania called Banca Transilvania. It trades in Romania. The ticker is TLV.
TLV?
TLV, yeah. And this is, we've been investing in it for over a decade. And the big insight that we had back in 2008, 2009, that this bank, unlike many other banks in the country, has an advantage by being domestically owned and domestically focused. And Romania at the time was a market where if you're a Romanian citizen, you could get a loan in domestic currency, Romanian lei, or you can get a loan in Swiss francs or in euros, and each bank would be allowing you to do that. But the foreign-owned banks were more likely than not to give you the loans in foreign currency. And Banca Transilvania, which was is domestically owned for the most part, had much bigger part of its business related in local currency, and had much quicker decision-making, and was focused on Romanian SMEs and retail. Mm-hmm. And after the 2008 crisis, when all of the other banks started pulling back, all of a sudden, this bank had this market completely open up for them because the demand for local currency loans went up, because the domestic currency went down relative to the euro, and people saw not just the benefit of having the cheap loan at a cheaper rate, but also the risk involved in it. So there was a lot more demand for local currency lending, and Banco Transilvania was the one that was able to satisfy that demand and was growing at a much faster rate than any other bank in the country. And in the last decade, went from a 2% market share to over 10.
Wow.
And became the largest bank in the country. And continues to be the biggest bank, continues to grow faster than the market because they have an advantage that they make decisions locally.
Yeah.
This is the story that we've done in the theme that we played in Banco Transilvania. In Romania, there is a bank in Lithuania called Šiaulių bankas, which is a very similar story, where if you have a high quality bank with high quality management in a country where the GDP per capita is growing, then you can make pretty good money by just latching onto them and letting them compound.
Is there an element of, and this might not be the right framework, but is there an element of like not in my backyardism with these local banks, where if you've got a bank as good as, Bank of Transylvania or, TLV, right? You've got a bank as good as them. Is it a competitive advantage where it doesn't really matter if there's a bunch of smaller banks? Like if that bank is so good at making decisions and investments and loans at the local level, like there's really no incentive at the consumer level to choose another bank. I mean, does that make sense?
I think it's a little different because you get quicker decisions. So if you go in for a loan for $1 million lei loan, your decision is going to be quicker at Banca Transilvania because the decision is made in Romania than if you go to a bank that is owned by SocGen, for example.
Yep, that makes sense.
So it's convenient.
They will
understand that. They will be able to understand your problems a bit better. So it's not so much not in my backyard, but more of a it's the local banking model.
Yeah. Got it. Let's shift now to Kazakhstan. And the only company, so disclosure, the only company that I know of in Kazakhstan is Kaspi, which is like the poster child. And shout out to Thomas Bachrach, who pitched me on Kaspi. I'm not even going to look at the chart because it's too depressing. He pitched me on Kaspi when it was, let's just say, well below what it currently is now. And it just looked, again, like one of the best businesses I've seen with total market dominance, trading at like a ridiculously cheap multiple.
So Kaspi, it's a very interesting story for me and for us as a firm, because this is one of the stations where the company was coming out. We tried to look at it and compare it to other companies in Kazakhstan. And the company that our big holding in Kazakhstan is the biggest bank there, called Halyk Bank, that is listed in London and locally. And if we looked at Halyk banking relative to Kaspi banking, well, Halyk banking looked more stable. Let's put it this way. But the mistake that Halyk did, and Halyk is it's this massive bank in Kazakhstan with over 40% market share. There used to be 3 large banks in Kazakhstan 15 years ago. One of them went bankrupt. Another one was going bankrupt and was consolidated into Halyk. So it became the only game in town for the longest time. And they were super profitable, doing pretty well, but weren't really paying attention to all of the market niches. And Kaspi used it to their advantage. And they came in and they built a business on 2 things for the most part. One is by offering consumer lending, unsecured consumer lending. And the second is by going to some of the smaller retailers and bringing them into a financial ecosystem by allowing them to take cards or to accept payments via the QR code. And they did a phenomenal job at that. But from a point of view of just banking business, when Kaspi was coming out, we looked at it as, they called it fintech, but it was essentially unsecured consumer lending on one hand, and we have a high quality bank that is doing everything on the other hand. We just weren't sure if that made a lot of sense. As far as everything else that Kaspi has done, and I have to give them a lot of credit because they built a phenomenal payments platform. They seemingly built a amazing marketplace business. Like, it is truly a super app that seems to be hitting out of the park.
Yeah.
But the type of money that they're making on all of these businesses is just unparalleled.
Yeah.
Anywhere in the world. You have a marketplace business with a 60% plus operating margin. Where a good one that's established, like eBay or Etsy, like you have 30. A developing one, like C, or pick one of them, or Ozone for that matter, they have negative operating margins.
Yep.
So these guys are growing and have these amazing margins. And to me, eventually, at some point, it's going to be challenged by somebody. Because you do have a market that is still relatively young. So the opportunity set is significant. And for somebody to just say, you know what, Kaspi, you guys did a great job, you can have it all and make billions of dollars. It's kind of hard to believe. So the question is, how well will they do responding to these challenges? Mm-hmm. And I just don't have an answer to that.
Yeah. Like if they just cut costs, right? And they just say like, look, we're going to take our operating margins from 40 to 20 and just pass all those on to the customers. Like that might be how they just stay on top, is they're just willing to take that hit.
It's absolutely possible. But I do think that they're currently operating in an environment that is probably is less competitive than it's going to be a few years down the road. And you can see that even from Holic, that did allow this wonderful business to develop in their backyard. Well, they're going after the thing. So they're building out their own marketplace and they're paying a lot more attention to the smaller businesses and to the retail consumers. Is it too late? I don't know.
Yeah.
But what Kaspi has done is great. I have nothing but respect for this management and the business, but we don't own it, and it's a mistake. Right now, it looks like a mistake, but time will tell what happens later.
Yeah, if any, I mean, for those that haven't either heard of Kaspi or just haven't looked at the, investor deck, I would encourage you to do so because it's just kind of humorous, just how much they've grown and how profitable the growth. Like it's unbelievable some of the charts that they post.
Exactly.
It's crazy. All right, let's shift to we can maybe touch on one more Eastern European country, Georgia, which is one I know that you're very familiar with. What are some world-class businesses in Georgia? And then maybe also talk about as a whole, to kind of wrap up this Eastern Europe thing, industries that you see over the next 5 to 10 years. I know we touched on tech becoming more of a portion of that, but specific industries or types of businesses where you think are going to be most attractive places to put capital, whether it's banks, whether it's consumer focused businesses, whether it's marketplaces. So start with Georgia, and then we can kind of trickle into that conversation.
Sounds good. So in Georgia, just to switch gears and not to talk just about again about another bank, one of the businesses that we like there is this company called Georgia Capital that was a few years ago spun out of the bank called Bank of Georgia. And the reason why that business was spun out is that Bank of Georgia was building under its umbrella a few non-core businesses that some of them grew out naturally from back in 2008. They took some assets on their balance sheet, and then from which they developed a pretty good construction business and like development business. Then they also had a healthcare business that grew out of them providing medical insurance. And after a little while realizing, well, the money is not really in insurance, but in being a provider. So they built a biggest hospital chain in Georgia that eventually became big enough to be spun out as a separate company. They had a water utility business that they were able to acquire at a very attractive price. So there's a number of businesses that were built under Bank of Georgia and built on their balance sheet, and that became big enough for them to be needing to spin it out as a separate company for two reasons. One is that regulator was getting increasingly uncomfortable with bank doing all of those things. But the other thing is that from a bank point of view, it became a problem because if you wanted to lend to another hydro utility company, then they would have a problem going to this bank because this bank is operating in the same business. So they would probably go to somebody else. So it was a competitive thing where businesses in the country did not feel necessarily comfortable with all of these businesses being under the Bank of Georgia umbrella. So, and this holding company was spun out a few years ago, I think it was in 2018, was spun out as a separately listed company in London. Mm-hmm. The ticker is CGEO. The company is called Georgia Capital. And it now gives you really a way to invest into the Georgian economy. Mm-hmm. And Georgia as a country is a pretty interesting case because this is the small open economy that is in some ways benefiting from most of their neighbors hating each other and not being willing to trade directly, but they're willing to trade through Georgia. You have an economy that's growing at 5 to 6% per year. You had an economy that was, I think 20% of their GDP was coming from tourism, and it's a wonderful country to visit. If anybody ever has a chance, and assuming we're done with coronavirus at some point, I strongly encourage to visit. But 20% of their GDP was linked to tourism. To understand how dynamic that economy is, at this point, where tourism is still 50% below where it was 2 years ago, the GDP is 10% higher than it was in 2019.
Wow. That's
even
crazy.
without the contribution for tourism.
Yeah.
So it's a very dynamic country, very dynamic economy. And Georgia Capital gives you exposure to a lot of the sectors within that. Georgia Capital. It has, I already mentioned, healthcare businesses. So they have the biggest hospital chain in the country, the biggest pharma chain in the country. There's an insurance company. There's a water utility business. There is renewable energy business that's based on hydropower and wind. There is consumer goods companies in wine and beer. There's online education company, like pretty much anything that is interesting, mm-hmm. they will probably participate in, and it is run by world-class capital allocators. So you can go and read their annual letters.
Yeah.
That they have on their website, and most value investors will be pretty impressed. Let's put it this way. And today you can buy it at a 50% discount to NAV.
Really?
And they commit to you that they're going to be reinvesting capital at high rates of return. So their minimum threshold is 15% plus.
Okay.
But one other hurdle for reinvesting capital that they have is their own stock price. So at their own NAV, at the stock price trading at half of NAV, that means that the actual hurdle on new investments right now is not 15%, but 25 to 30. Or they're going to be buying back shares, which is what they're doing.
That's really interesting. I like that idea. Wow. So you're basically buying like a PE venture capital business in the public markets.
Correct.
Huh. Okay. So then that kind of leads us to the last question here, in terms of, Eastern European investments. If you kind of had to cherry pick, call it 2 to 3 industries or kind of subsectors that you think are the most attractive or even the most exciting to invest in within these regions and countries, where would they be? Is it software? Is it marketplaces, consumer businesses? Where does it fall?
For me, the answer is still banking, because what are we? 13 years past the financial crisis, and it's still the pariah industry. But if you're looking for true compounders, Banks in Eastern Europe are it. Because if you have an economy that's growing 4 to 5% in real terms, which means it's growing 8 to 9% in nominal terms, and it's underbanked, which means they have to put a multiple on that. So probably the banking assets overall are growing 10 to 15%. And if you have a high quality bank operating within that country that is generating ROEs of 20% plus, which a lot of them do, then you can get a very good business that has a natural growth rate of 10 to 15% per year. And you're paying for them. And by the way, stepping back, this is the business that will benefit from the growth in the economy, because they're going to be lending to whatever needs money, wherever the capital needs to flow.
Yep.
And today, you still have these businesses trading at single digits, P's.
Yeah.
So for me, unless that changes, this is really the most attractive place to invest in the region. And there is a devil in the detail. Like, you have to find the good bank. So investing in cheap bank has been probably one of the worst ways to invest, because there's leverage to it. There's cheap banks are not a good idea, but good banks are.
And it goes back to what we said earlier, where it's not about finding the cheapest name in Eastern Europe. It's about finding the highest quality business. So it's kind of like that theme over, intertwines really everything we've discussed, which, that meet that we just, going from Russia to all these places, that was fantastic. I mean, there are so many ideas that I've got to dig into now just to add to my laundry list of watch list names. But I want to end our conversation with this debate on Russia versus China. And it's something you and I discussed actually on the way back from that one event in Vail where I think it was a camp something. Is that Camp Hale? Yeah. Camp Hale. It's my frustration is on Twitter, so many investors are quick to invest in Chinese businesses, while at the same time discourage and even look down on people that invest in Russian businesses. And to me, that just seems like one of the biggest hypocritical statements one can make. So having you on, someone that has hands-on experience in Russia, local knowledge, walk us through that juxtaposition and kind of why it's almost silly for someone to invest in China while at the same time having these basically having these doubts about Russia and making those comments.
I'm not sure if I'm the right person to ask that question, because we don't invest into both countries. So I feel very comfortable investing and talking about investing in Eastern Europe. But as I was saying earlier, for me, China is not a market that I know a lot about. But what I can say is that I'm pretty sure each emerging market has its risks. And in some cases, the risks are the first things that people are thinking about. And in other cases, opportunities is the first thing that people are thinking about. And I would encourage people to have a balanced look at both. Look at the risk, look at the opportunity, and try to approach it with an open mind, as opposed to this teenager kind of attitude where you have all the answers but don't know the questions. It's more about knowing the questions and trying to listen for the answer. And this is what we do every day in our job. As I was saying earlier, I know for a fact that the people on the other side of the trade from me are smarter and probably better looking. But you have to get comfortable with that. They know more about the companies. You have to get comfortable with that. You have to understand how you invest, what is your edge. What is your time horizon? What is their time horizon? What is your cost of capital? What is their cost of capital? And really trying to understand, well, this is the problem that everybody knows. Are you comfortable with it or not? Right? And the problems are there in China, the problems are there in Russia, the problems are there in Latin America. But is this the first thing you're going to think about, or are you going to look at the high quality business that you're getting?
Yeah.
And I would argue that for the longest time in Russia, it's been the problems that were first on the mind of the investors. And in China, they may not have been.
Yeah.
So if I will ask you a question, I had to look it up before this conversation. If you would have to guess, what had a better return over the last 5 years, MSCI China or MSCI Russia?
I mean, originally I would say China.
It's not. It's Russia. So over the last 5 years, China has returned you about, I think, 50%, and Russia is over 100. And I had no idea.
Mm-hmm.
Right? And today, Russia is at PE of 9. And the forward PE, I think, of 7.5. Like we back in 2006, 2007, we were in a situation where, well, this is expensive, but our stuff is cheap. And I'm talking about Eastern European markets. So the stuff that we own is cheap, but everything else in our market is expensive.
Yeah.
That was wrong. Everything was expensive. Today, we're looking at our portfolio and say, our stuff is cheap and good. All the other stuff in the market is not expensive. So it's kind of like cherry picking.
Mm-hmm.
And it's a very good point to be at.
Yeah. It makes me wonder how much sentiment would change. And this is kind of, a joke in some parts, but how much sentiment would change if Charlie Munger or Warren Buffett bought a Yandex or bought like one of those, leading Russian oil companies. Because there seems to be this like zeitgeist mentality around Munger where he buys Baba, he double down buys on Baba, and Twitter just eats it up, and value investors just eat it up. And it's like, man, like imagine if Buffett bought Yandex and just had like this succinct investment thesis, like what that would do for investors' sentiment towards Russia.
I have no idea. To me, this is all.
I have no idea either.
I can't even dream of something like that. But what I know is that we're long-term investors. Our average holding period is 7 years. And if I can buy a business today at single digits that is growing at 10% per year, I don't need the multiple to change.
Yep.
I'll be making my 15 to 20% per year.
Yeah.
All things being equal.
Yeah.
If multiple changes, awesome.
Mm-hmm.
But then I have to figure out what to do with money.
Yeah. I think maybe to tie a ribbon on this question, one of the biggest differences though, right? Risks aside, there's risks in Russia, there's geopolitical risks in Russia, there's geopolitical risks in China. But one thing that I do think is a differentiator is what you actually own as a shareholder, which I think is an important distinction. In Russia, like we said earlier, you own the same stocks as the majority shareholders, and you get, disbursements just like the majority shareholders if they choose to disperse. In China, however, there are some instances where you're not actually owning the company, but you're owning a VIE, and your shares are VIEs, which are completely different. And so if you want to, riff on that a little bit for people that don't know kind of the differences there, I think that might be one important distinction.
Right. Once again, it's a risk reward.
Yeah.
And in some cases, it's the risk that you think of first, and in other cases, it's reward. But the risk reward may not be very different.
Yep.
Right.
Got it. All right, cool. So this has been a sweet deep dive into Russia and Eastern Europe. And I'm sorry, we went over the hour and a half, but I hope that it wasn't too bad. I'm going to end with a couple concluding questions that I ask everybody. But the first one, since you invest in Eastern Europe particularly, this one, it might be like picking a favorite child, but if you can invest in only one country for the rest of your life, where would it be and why?
I knew you were going to ask that question. And I don't have an answer to that. It's unfortunately, it is like, so I have 3 children, and it is like picking your favorite child. And especially, I don't know how the markets are going to develop over the next 10 years.
That's true.
Over the next 20 years, over the next 30 years. It's going to be fun watching. It's going to be fun participating. But do I know if Russia is going to be the same way 15 years down the road? I have no idea.
Right.
Do I know if Estonia is going to be the same way 15 years down the road? I have no idea. So you have to have your pulse on the ground, like you have to understand what's happening. You have to watch it. You can't just let it go. It's not a buy and forget type of proposition.
Mm-hmm.
Right. So from that point of view, I think investing in Eastern Europe at the moment has fantastic rewards. You have different countries that have different value propositions. You have Russia and Kazakhstan that are more resource-driven companies, and you have to treat them as such. You have emerging Europe countries that are more convergence type countries, where you're more likely than not to find a consumer-oriented business. So from that point of view, we're looking at them at market by market. We do not say that this is the place where we're investing in more. This is the place where we're investing in less. Russia has been, we spend a lot of time on this conversation talking about Russia, and Russia has been a recent focus for us from a point of view of new investments, in part because we've seen the quality of the businesses improve, but the valuations are not going up. So that's been a place where we've been allocating more resources recently. Back in 2014, our answer was very different because the risks in Russia at the time, during the conflict between Russia and Ukraine, were elevated. So we took our Russian exposure down dramatically in response to that, because we saw a change in risks. How the next 10 years are going to develop, I have no clue. Right. So for me, it's very difficult to answer that question.
Yeah, no, I mean, I part of me when I wrote that question out, I almost threw it in like the too dumb to ask pile. But it somehow made the cut. So there we go. Next question. Where can people go to find out more about you? I know you're on Twitter, so give us the Twitter handle, and then any website that you want people to know about. Drop it in here.
No, I actually need to look up my Twitter handle. So I'll do that as we speak. But I do know our website, which is, so the website for Firebird Management is www.fbird.com. And we have quite a bit of information there our investment team is 5 people. Two out of the full founders of the firm are still there day to day running the firm. I love working with them, with Harvey and Ian. And we put out a reasonable amount of information on kind of our thought pieces on investing in Eastern Europe and questions like Russia versus China. It's a recent piece that we added to it. So that you can find on the website. And then if you're a qualified investor, there's a little more information on our funds as well. But that you would have.
What's your Twitter? Did you look that up?
I did. It's Steve Gorelik, SteveGorelik.
Very, very fancy name.
I know.